This past weekend, Intel announced that the US government was taking a roughly 10% stake in the company. This is a multi-billion-dollar investment in Intel. I actually view this as a potential turning point for the company, where it might have significant upside potential in the years ahead if they execute on their vision and the strategic investments that they're looking to make. So let's talk about what's going on with Intel, where they are today, where they might be in the future, and why it could lay the groundwork for Intel being much higher in the future. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. So let's dive right in. So first of all, this decision, this announcement was met with applause by several industry titans. You have Satya Nadella, who's the CEO of Microsoft, talking about the importance of rebuilding this critical industry on American soil. Michael Dell, founder of Dell Technologies, a lot of laptops using Intel chips, talking about the importance of Intel and Trump administration working together and the importance of having a resilient U.S. semiconductor industry. And then also Matt Garman, CEO of Amazon's cloud division, AWS, talking about the importance, making U.S. investment in this critical industry one of the most important technological, economic, and national security imperatives of our time. In case you didn't get the sort of reading between the lines from each of these titans of industry, what they're saying is this is a potential bottleneck, this is a potential choke point, these chips, this manufacturing. Currently, the vast majority of the most cutting edge chips are coming through Taiwan Semiconductor. In Taiwan, you need to have the supply coming from effectively redomesticated. It's back on U.S. shores. So that way, if there's any time in the future that the U.S. cannot still have access from, let's say, Taiwanese chips, that it still can produce its own. It can still have its own cutting edge. So this is about redundancy. This is about looking at what happened during COVID. This is about looking at, effectively trading relationships and saying, we want to make sure that we are resilient in what is otherwise a critical industry. That is the message that all these executives are saying. It's important that it's U.S. produced. And the terms of the deal are kind of interesting because it's really about taking what was previously a grant from the CHIPS Act, I believe that was under President Biden, effectively adding a tweak to it saying, yeah, if you're going to get around $9 billion from us, where, this secure enclave program, meaning building the chips, building a foundry in the U.S. or on U.S. soil, what we're going to say is, yeah, Congress set aside this money for you, but President Trump is saying, yeah, in order to get the part that hasn't been distributed yet, we want a little piece of the pie. Now, smart minds will disagree, or come to have different opinions on, should the U.S. government be getting involved with owning pieces of the pie of individual companies? My personal view is that if the U.S. government, on behalf of taxpayers, has to put up money or is putting up billions of dollars to help industries that are critical to the country and obviously help those businesses as well, it should benefit. It should get a piece of the pie and, get part of that upside. The U.S. taxpayers, citizens should get that upside. I'm not saying that the U.S. government should get involved from a control perspective. I'm not saying the U.S. government should get, super voting shares or something like that. But what we're talking about here is roughly 10% ownership stake, around 433 million shares at around $20.50. And they also have warrants for another 5% if effectively Intel sells down their ownership stake in their Foundry segment to, I believe, 51% or below, or maybe it's below 51%. And then, they could get the right to buy even more because they're saying, well, wait a second. The point of this deal was we're giving you this money so that way the Foundry segment gets built out and we have this resiliency for the U.S. economy. And if you ultimately sell down that stake, wait a second, you're effectively transferring money that we give to you to somebody else. We want to own a greater piece of that if you're going to sell down the Foundry stake. So that's, these are the different dynamics. Once again, you have the commentary from the CEO talking about how the most advantaged technologies are American made. So this is very much about U.S. resiliency. Looking at Intel sort of as it is today, second quarter, you have around $12.9 billion in revenue, up 0.2%. This means this is a company that's losing market share or not holding, this is stagnant. You don't want to see this, in my opinion. You want to see companies that are posting strong growth. So when you're saying, yeah, up 0.2%, When you have competitors, players that are growing much faster, you are losing market share. Full stop. That is a red flag. Another data point on where they are today. You're looking at gross margins. They're down a lot. They're down 9 percentage points year over year. That is a huge compression. That means customers are effectively, generally that means that customers are saying, yeah, whatever price you're previously offering, it's not good enough. We need to get some sort of concession. That's the sort of dynamic you usually have. It's not great to see this type of margin compression. And then you're seeing earnings that are negative. None of these are, in my opinion, good data points. So you might be wondering, why am I sort of saying having a bullish take on Intel? And that's more towards the second half. This first is, let's just understand where Intel is today. So you have their consumer or their client group segment generating, looks to be around $12 billion, combined, but the client group and the data center, you're talking about probably around $12 billion in operating profit. You can see around $2 billion in the most recent quarter, $0.6 billion for the data center / AI segment. So combined around $3 billion per quarter in operating profit. So around $12 billion in operating profit per year. You can see their client group, this is, I think, like retail, effectively input or end demand. Really, this is contracting. This is not growing the way you'd want to see. And the data center segment, that's not growing the way you'd want to see. Margins have improved a bit, but overall, this is not a pretty picture. Still, $3 billion in combined operating profit. That's not bad on a quarterly basis, $12 billion on an annualized basis. However, the Foundry segment, this is where it's real costly. And you can see just billions and billions and billions in losses. This is a money pit right now. $3 billion in negative operating, effectively $3 billion in operating losses alone in the second quarter. And so this is part of the reason why the US government is saying, yeah, we will give you this grant for 10% of the stock. And, it's billions of dollars. It's to help you get through this valley. So that way the Foundry could be profitable in the future. So looking at the quality of the segment, this is leveraging Flash, which is an AI tool I leverage. I'm the co-founder as well. It's free for you to use, so feel free to check the link out below. It shows very clearly that Intel's quality is not great. This is a below average score. Profitability stinks. Their track record the last few years stinks. You're looking at questionable revenue quality. Market position is clearly fallen behind. This is analyst sentiment. Generally, investors and Wall Street is not excited about where Intel is. And so the question is, well, can Intel actually turn it around? What are the data points I'm starting to see that makes me say, yeah, there might be potential here? So first of all, you have this new CEO that came on board just in the last few months in March, and that is Lip Bhutan. And his prior track record was with the CEO as CEO of Cadence Design Systems from 2009 to 2021, where he led a reinvention of the company and drove a cultural transformation centered on customer-centric innovation. That sounds exactly like what Intel needs right now. Reinvention, focus on the customers, making sure you're delivering value for your customers so you can get those higher gross margins versus seeing a gross margins collapse like we talked about for their second quarter results. They also talked about how during his tenure, Cadence more than doubled its revenue. So not a lot of revenue growth. It more than doubled its revenue, but expanded operating margins. So it expanded its profitability and delivered. This is the thing that should get Intel investors very interested, a 3,200% appreciation. So this is a guy, when I'm looking for management alignment, I'm looking for teams that either have a lot of skin in the game or they've done it before. Ideally both, where they have a lot of skin in the game, they're a founder, and they previously sold a company or previously with a company where they made thousands of %. Love it. So this is a data point that I think is quite favorable for Intel shareholders. This is one of the key aspects that gets to, if you use your imagination, it's possible to see Intel as being worth a lot more from here because you have a CEO that's done it before, the reinvention of a company. You have the prior targets. This is not from the new CEO. This is from Pat Gelsinger. Apologies for massacring his name. But where he previously, had penciled out Foundry margins. So this is what's currently the money pit, billions of dollars each quarter, talking about 40% gross margins, 30% operating margins. So this can be a very lucrative segment over time. It's a money pit now, costing billions and billions of dollars. And, it's very clear. They are focused on getting to improved margins. They're very clear on getting to 50% gross margins. This was based on recent conferences with Bank of America, where their head of Intel products was saying, look, the CEO is laser focused on maximizing shareholder value, and it's important that any products have at least a 50% gross margin. So this is about resetting, their potential. And you also look at what Taiwan Semiconductor does. I mean, this is a company, most recent quarter, $30 billion, $30 billion US dollars in revenue, 59% gross margins, 50% operating margins. So you could see, if Intel doesn't even, get to this status, assume this is the premium standard, assume Intel never gets here, but gets a fraction of it, then, you're saying this is the North Star. There's a lot of potential here. There's a lot of operating margin potential if you look at, where Taiwan Semiconductor is. So as I think about, sort of Intel, is this potentially a bottom, where it really does start turning around based on this US government grant / investment? Well, first of all, this is not financial advice. I don't own a stake in Intel. And also a quick plug, Justin W., a premium subscriber, wrote, thanks for the great content you've been putting out. I've really enjoyed learning from you about investing over the last 4 years that I've been a member. This follows Matthew, who said Netflix, Spotify, and Unrivaled are the only subscriptions I'll never cancel. Seriously, this is an incredible value. You've helped me and my wife comfortably take time away from work to travel and had the financial confidence to start a business of my own. If you're looking for compelling ideas, come check out Unrivaled Investing. So thinking about, Intel, where it is today, you have a business that is generating around, as I already mentioned, their non-Foundry business, looking at the client computing group and the data center / AI segment, is generating around $12 billion in annual run rate operating profit. That's from the most recent quarter. If you throw, let's say, a 10 to 15 times multiple, then you're talking about $120 to $180 billion in value for this. Now, there's a lot of, this is a very simplified perspective because it doesn't factor in the $50 billion in debt, the several billion in interest expense that they're going to have. But, there should be some tax assets as well from the losses that they've generated. So it is important to understand these different dynamics. That said, these two segments alone, you could argue, have 100 to, let's say, $180 billion in value based on roughly today's results. So this is a question of, do you think these segments, based on new management, do you think they can hold their value or potentially increase their value over time? And if you have investors start thinking, yeah, this could increase their value over time, then you are talking closer to that $200 billion valuation. Now let's think about their market capitalization because you have these new shares. So you have the diluted share count at the end of the most recent quarter. You have some anti-dilutive adjustments because the quarter was unprofitable. Then you have SoftBank recently made a $2 billion investment. You have the US government shares, 433. So all in, looking at the share price, around $25 per share, you're talking about a market cap around $125 billion. That's kind of interesting because I just talked about how those two segments, their two key profitable segments, arguably are worth that figure. And I said 120 to 180. So you might even say those two segments alone might suggest 50% upside. Those two segments alone. So then it gets down to the Foundry question. That's arguably a $100 billion question, which is, can Intel's Foundry be profitable in the future? And once again, thinking about Taiwan Semiconductor, $30 billion in revenue during the most recent quarter, 49%, 50% operating margins. Those are incredible margins. So if you were to imagine that Intel's Foundry at some point in the next 10 years is, let's say, only 20% of Taiwan Semiconductor's current size. So if they're doing, let's say, $120 billion in, annual revenue, or excuse me, $120 billion in annual revenue, and they get 20% of that size. So by no means like taking all the market from Taiwan Semiconductor, just saying 20% of Taiwan Semiconductor's size. So they get to $24 billion in revenue, and they only achieve 30% operating margins versus Taiwan Semiconductor's closer to 50%. That's $7 billion in operating profit. So once again, that's kind of an interesting angle, because that $7 billion in operating profit for this foundry, what's that worth? When you say, yeah, you're providing a critical service that the country has said, hey, we want a stake in. We view this as a bottleneck. We view this as a national security concern. What multiple do you put on that $7 billion, which is close to a monopoly type of business? That type of aspect. It's not going to be monopoly because it's still ruthless global competition. But what type of multiple should that get? And if you assume, let's say 10 times, throwing out a figure, then you're now talking about, okay, if the existing core profitable segments keep their profitability and they ultimately prove that Foundry could, let's say over the next 10 years, investors start saying, yeah, this could generate $5 to $10 billion in profit per year. Then you could have a situation where investors say, yeah, that Foundry segment, maybe that's worth $100 billion and their existing segment is worth the current market cap. So then you're getting close to 100% upside just from sort of combining these pieces. And this assumes no improvement in their existing core operations outside of Foundry. So, when I think about Intel, as I sort of run it through my own personal investment checklist, aligned management, I would say it has the management that's done it before, which is what I really like to see. From a compelling valuation, I'd say if you see these data points of turnaround continue to pick up steam and continue to deliver, sort of this very rough framework that I've talked about, where their core segments keep their profitability, Foundry starts improving, capturing share, showing that they can be profitable, then I would say it is a very reasonable valuation. And then in terms of obvious growth potential, that's probably where it fails my personal investment checklist, just because a lot of this is conjecture. A lot of this is, I hope this works. I hope Intel gets a Foundry that works. I hope their existing segments, their profitability doesn't get, eaten away by hyper tough competition, the AMDs of the world. It's a incredibly tough business across their different segments that they operate in. And so I don't view this as obvious to me that this is going to happen. There are some things that are obvious that I call out to my subscribers. I did a recent letter on one where it's like, hey, this strikes me as very obvious that this could be multiples its size in the future. Intel very much could be, but it doesn't go in that obvious camp. So overall, as I'm thinking about Intel, I like the setup. I like the dynamics of the CEO that's done it before. I like seeing, frankly, the alignment with the US as a country saying, yeah, you better deliver value. Now that is a double-edged sword because, frankly, the US government may not care what your margins look like. They might just say, hey, we need to make sure you're actually generating revenue via, shipping us the chips that we want. We don't really care what your margins are. We don't care if you're getting a Taiwan Semiconductor type of margin. You could be getting break-even margins for all we care. That said, their stake in the company does suggest that, yeah, they would benefit from having lucrative margins. So you have those different dynamics at play. But overall, I like the alignment. I wouldn't like it if the US government said, hey, we're going to be calling the shots going forward. And we now have a voting stake that controls this company. But look, this is as far as I can tell, this is not the controlling shareholder now. This is now a more of an aligned party. So I personally like this development. I view it, if you were to step back and say, well, what's the Trump administration doing? They've made very clear repeatedly that they're looking to have some sort of sovereign wealth fund. So I believe this is going to be one of the investments that they call out for their sovereign wealth fund. I think the mortgage insurers, which I've talked about several times, I think that's also going to be a key part worth hundreds of billions of dollars for the sovereign wealth fund. So I think there's a lot of different angles to this. When I think about Intel, would not surprise me if this is sort of the turning point for them. And I hope Intel shareholders do well. I don't think it's probably going to be part of my own investment journey. I think if I were more of a speculator, then I would say, yeah, maybe I'd consider some sort of position, but it doesn't really fit my checklist. So it would be more of a special situation type of bet. I hope this video calling out Intel, the data points I'm seeing that might suggest that this indeed could be turning around, is helpful for you. Thanks so much for watching Unrivaled Investing.